Hi everyone. In Chapter 7, we will be looking at the valuation and characteristics of bonds. So specifically, we're going to first look at the different kinds of bonds and then explain some of the more popular features that are on bonds. And then the portion of the chapter is we'll be defining the term value for several different purposes with regards to a bond and how we determine the value of a bond. And we keep going. Computer bonds expected rate of return and its current yield, and then three important relationships that exist in bond valuation. Okay, so our focus is on bonds. So before we even get into how to value it, sometimes people have a hard time with that term bond. So a bond is basically a company or a governmental unit asking the public to borrow money. So to the company or the government, it is a liability. And it's essentially saying, if you buy this bond, essentially you're loaning us money. We will pay you interest at certain points in time during the year at a certain rate, which we call the stated or coupon rate, until a certain date. And at that point, we'll pay you back the face value of the face value of the loan. And that's all a bond is. It's packaged so that it could be bought and sold. So when someone in the public loans a company money, they're actually purchasing a bond, and then they own it. Now, when you loan someone money, normally you have to wait until the loan matures and to get your money back. But as a bondholder, at any time, you can sell your bond to someone else, the bond that you own. And now they have the rights attached to that bond. So we have a bond market for those kind of transactions. Again, bonds are usually issued by corporations, U.S. government, state and local municipalities. Now, there are certain characteristics of a bond. For instance, debenture bonds are unsecured, meaning there's no collateral attached to them. So when the corporation sells the bond, essentially borrowing the money, the person buying the bond is essentially buying it in good faith that they're going to receive their money back because they're not buying it with collateral. So if the corporation doesn't honor the bond payment, there's a risk there that the person buying it will not get their original investment back. And you could see, now the more risky a company is with regards to paying back that bond, the higher the interest usually associated with that bond because the bondholder, the person purchasing the bond, is taking on a lot more risk. Now, before we go into subordinated debentures, and if you're sitting there going, well, how do I know what bond to buy and how much risk is associated with it? There's companies out there, S&P, Standards & Poor's, they will actually rate bonds. I think Morningstar is another one that they tell you, okay, if you're buying a corporation A's bond, here's the kind of risk associated with it. And they do it by a star system or a numbering system. So the credit worthiness of a company is published out there. So an investor isn't purchasing a bond blindsided. Okay, they know that there's risk, and then they could determine the amount of risk based on this credit report put out by these companies about the corporation selling the bond. Okay, so subordinated debentures. So there's a hierarchy of payout in case of insolvency. So if the company sells more than one bond that's a debentures, then they may be stacked. This debenture gets paid out first in bankruptcy, then this one, then that one, then that one. So it's the claims of subordinated debentures are honored only, though, after the claims of secured debt and unsubordinated debentures have been satisfied. So that is very important to the investor. If I buy this debenture and this company does go bankrupt, will I get any of my money back? Who gets their money before me? And if you've had a business law course and studied bankruptcy, there is an order to pay out of assets of a corporation when they file different types of bankruptcy. So the more unsecured you are, the more likely it is that you are not going to receive your money in insolvency or bankruptcy. There are also mortgage bonds. A mortgage bond is secured by real property, land, buildings of the corporation or the government unit. So if there is a default that the corporation doesn't pay the investor their money at maturity, that bondholder, the investor, has a claim because they have it collateralized. Typically, the value of the real property is greater than that of the bonds issued because then there's a margin of safety for increase or decrease in value of the real property that is secured by the bond. Just like if you're familiar with mortgages through the banking system, generally, and I know this is kind of off subject, but to understand this whole concept of a mortgage, generally a bank will only loan up to 80% of the value of a home without asking for some type of protection for the other 20%. And that protection is a mortgage insurance that the borrower must take out for that other 20% if they borrow more than 80%. Well, why will a bank only loan up to 80% normally without any other protection? For the same reason. If the mortgage holder defaults, they have to sell that property to get their money, right? So if that property fluctuates in value, they have a 20% range there between what the property's currently at and the mortgage they actually provided for the property. So it's the same kind of thinking. Eurobonds. These are securities that are issued in a country different from the one in whose currency the bond is denominated. So if a bond is issued by an American corporation in Japan, it pays interest and principals in dollars. Okay, so it's just a term to use to describe that type of security. Convertible bonds are another kind of bond. So not all bonds are going to be sold this way. We're just letting you know the different kind. If a bond is a convertible bond, it generally can be converted or transformed into a firm's stock at a certain price. So if the company near maturity or at a certain point may say, instead of us paying the bondholder back in money, we'll pay them in our stock. And we'll assume it has a certain value attached to it. And that's companies will do that to pay off the bonds. They convert them into the stock of a company. So a bondholder may be interested in that type of bond. Okay, so those are the different types of bonds. Remember, they're issued by corporations and the government. And remember, they are essentially loans from the public to these entities, and these entities promise to pay back interest and a face amount at maturity. The interest is paid at certain intervals until the bond matures. So let's look at some more terminology and characteristics of bonds. Now, There's seniority in claims. So again, in the case the corporation is insolvent, its assets are less than its liabilities. Okay. Claims of debt, including bonds, are generally honored before those of common or preferred stockholders. So there usually is more of a senior claim to get your money back as an investor in a bond. Par value. This is very important. We use a couple different terms, for whatever reason, to describe the same thing. Par value, face value, maturity value. They all describe the same thing. It's the amount the corporation promises to pay when the bond matures. And it is written right on the bond certificate. It's in stone. It has to be paid. Remember, just like a loan, when an investor buys a bond, they essentially loan the money to the corporation. The corporation gives them a legal document, a bond certificate, that identifies the rights and responsibilities of each party. It's a contract. Contracts cannot be changed with whiteout, right? So when the corporation says, we promise to pay you $1,000 when this bond matures, we call that the par value or the face value. Now you're going to see in a little bit, just because the corporation promises to pay back that much doesn't mean that's how much the bondholder actually loaned the company or paid for the bond. In general, so that there's more opportunity for more people to purchase bonds, bonds normally have a par value, face value, maturity value of $1,000. And when they're quoted, they're usually quoted as a percentage of face value. So if a bond is quoted or selling at 104, it is selling at 104% of its par or face value. And this is what I was just talking about. The corporation may sell the bond for more or less than its par value, but it must pay back par value at the maturity, no matter what was received when they first sold the bond. Another important term is the coupon or stated interest rate. And this is the interest rate that is right on the bond that the corporation promises to pay at certain time intervals until the bond matures. For example, a bond with a $1,000 par value and 5% annual coupon or stated rate will pay $50 annually, 5% of par, and that's always how you calculate the interest payment. The coupon or stated rate on the bond certificate times the par value. If it's paid twice a year, you would split that in half, and the bondholder would receive $25 every 6 months. Sometimes bonds have what's called zero coupon bonds. They have a very low interest rate or no interest rate. Instead of paying interest, the corporation is not going to be sending out interest every 6 months or a year. Instead, they charge a lot less for the bond up front and then just pay the face value at maturity. And that difference is considered the interest, because they only charge maybe $600 for the bond, and 5 years from now they'll pay back $1,000. Maturity. This is the day the bond must be repaid to the bondholder. So the loan is going to be repaid to the bondholder, and no matter how much the bondholder paid for the bond, they're going to receive the par value when the bond matures. Now remember, we talked about convertible bonds, or sometimes this applies to convertible, but it also is what a bond could be called. And it has to be within the bond certificate. So this call provision must be stated in the contract. And what is it? Well, generally, a corporation will wait till the bond matures to pay it back. But if there's a call provision, it gives the corporation the right to redeem or pay back the bonds before the official maturity date. For example, if the prevailing interest rate declines, the firm may want to pay off bonds early and reissue at more favorable interest rates. So the corporation must pay the bondholders, usually we call it like a sugar of premium. You got to entice them, right? And that's what sugar does. So we'll pay them a little bit more to get them to let us buy their bonds back. And we are allowed to do that because it's in the contract. There's also a call protection period where the firm cannot call the bond. So there is some protection there for the bondholders, but that's very important for a bondholder to know. Is there an opportunity for the corporation to pay this back early? Indenture is the contract. Okay, that's your bond certificate. And it is a contract, as we said. It's a legal document upheld in a court of law between the firm issuing the bond, the corporation, and the bondholder. It's going to tell the specific terms of the loan agreement, the bond. What's your right as the bondholder? What's the rights of the issuing firm? We already talked about that. Many of the terms seek to protect the status of bonds from being weakened by company action or by other security holders. Okay, so that is our official contract. As I said, there's bond ratings. They reflect future risk potential of the bonds. Standard & Poor's, Moody's, and Fitch Investors. I think Morningstar's out there still too doing it. All right, so lower bond ratings indicate higher probability of default. It also means that the rate of return demanded by the capital markets will be higher on such bonds. So a low bond rate, high return. Because you're taking a lot of risk, right? Here's some of the Standard & Poor's corporate bond ratings. So you could take a look, read through those. These are in your book. And maybe check out some companies you might be interested in to see what kind of bond rating do they have and what does that really mean. Some of the factors that affect the bond rating are, does the company have a greater reliance on equity as opposed to debt? Okay, so do they have more in equity? Profitable operations, of course. Their past earnings don't vary greatly, so they stay pretty consistent. The firm size, and they don't use a lot of subordinated debt. Okay, so these are all positive financial factors and will help keep the bond rating higher. Remember, there's no guarantee. Junk bonds. These are high-risk bonds with ratings of BB or below by Moody's and Standard & Poor's. They're often referred to as high-yield bonds, and they pay a high interest rate, usually 3 to 5% more than the AAA rated bonds. And whether you like them or not, Donald Trump was famous for these in the 80s. And that's how he took a lot of risk on. And I believe junk bonds caused him to file for one of his bankruptcy because he took on this risk, made a lot of money off them, but then when they fell, it affected him financially because there's a huge risk. And if you invest a lot of money, it's just like gambling, you could lose it. Okay, so those are our terms. So it's very important we keep those straight in our head so that we could start getting into how do we determine value. There's different kind of values associated with the bond. There's a book value. Book value is the value of the item on the balance sheet. Book value does not reflect fair value. It may, but it isn't always equal to fair value. Liquidation value is the dollar sum that could be realized if an asset were sold individually and not part of a regular company. It wasn't attached to a company. Market value. This is the value the asset's actually selling for. So if you looked at it from a bond perspective as an asset. Intrinsic or economic value, also called fair value, it represents the present value. So there's present value, right? We can't escape it. So what's that worth today? What are we talking about? How much the asset will make in the future. So what are the cash flows expected of this asset? Now let's discount them back to present value. What is that worth today in terms of today's dollars? Because that future has interest in it. Future money always has an interest component. We've got to pull the interest out of it by discounting it back and determining its value as of today. Those future cash flows, if we do that for each one of them, that will tell us its value, intrinsic or economic value today. Now, theoretically, in an efficient market, all stocks and bonds at any time reflect all available public information. Remember, we react to information in the markets. Somebody posted about, I forget who it was, but they posted about, why don't we have like AI to do this for us already? Because, you know, we have so much information about the market. Artificial intelligence should be able to help us predict stocks and bonds, but we forget, you know, sometimes about that emotional component. And we all react to public information different ways. So one, we react, and two, we react in different ways. So in an efficient market, the assumption is every piece of information about the market is available. The other is that if the markets are efficient, market value and intrinsic value will be the same. So that's an assumption we're making here. So what does determine value? Okay, before we go into this, we need to understand something about bonds. A corporation doesn't decide to sell bonds October 7th and start selling them. And now it's a process. So maybe the board of directors of the corporation with the higher levels of management get together and say, we need to raise some money. And maybe it's October 7th when they get together. We need to raise money. We can't go to the banks and ask for this money. It's just too much. It's just going to take too long to go through all of the process that a bank requires. We have a good ratings on Standard & Poor's. Let's offer a bond sale. All right, so they all agree. How much money should we raise? They agree on a dollar amount, $1 million. What interest rate should we pay? So they have to think about that because interest rates change constantly. So they have to try to predict an interest rate for around the time they're planning on selling these bonds. So they do that. So they send the information off to accounting and legal because they have to do their magic. First of all, make sure, is this sustainable? And second of all, we got to get this legal document together, this bond indenture, and get all the information on it. Then we got to send it to printing. This could take a month and a half, 2 months. So maybe they discussed the fine elements of the bond on October 7th, 2019, but the actual sale date doesn't happen until January 1st, 2020. So time passes. So keep that in mind. There's a time passage here. Now let's talk about value. The value of an asset, remember, is the present value of its expected future cash flows using the investors, so what does the bondholder want? Required rate of return as the discount rate. So if you are trying to determine present value of an investment, you say, what does the investor require? What percentage of interest? Okay. And that's what you use as your interest component when calculating that present value. So value is affected by three elements. One, the amount and timing of that future cash flow, the riskiness of the cash flow, and the investor's required rate of return for taking on that investment. So those three things added together determines the value. So there's a nice little flow chart of that. So what does that have to do with bonds? Well, from an investor standpoint, it's an asset, right? From the corporation standpoint, it's a liability. Okay, let's look at it from the investor standpoint. We want to value the bond. We want to determine what is the fair value of this bond that we're thinking about buying. We're going to look at a couple different things. We're going to look at the future expected cash flow. Now, we already said, what are the two things that will come back to the purchaser of a bond? Interest and principal. The time to the maturity of the bond, the loan, and the investor's required rate of return. What do they want out of the bond? So there's a great formula, but as we've been discussing in our discussion forums, who wants to use these formulas? So if you want to use them, you do it. But we'll show you through the financial calculator, which is still my thing, and you guys can even use Excel formulas, which I'm not as familiar with, to do these calculations. So let's look at valuing a bond. Remember, when it comes to these three items, to value a bond, the first thing we need to define is the cash flow. And there's going to be two separate cash flows, two separate ones from a bond. The first is an interest component. So the investor will receive interest annually or semi-annually. So in our example here, it says on this bond, they're going to receive $65 a year. Now remember, we calculate that $65 based on the bond's par value and coupon rate or stated rate on the bond. They're also going to receive the principal or par value amount at maturity. In this case, $1,000. How long will this mature? For this example, 12 years. And what's the investor's required rate of return, which is generally the market rate? What everybody else is getting, 4%. Okay. Okay, that didn't work, right? So we're going to use all those components to calculate our bond. Let's look at this example. Consider a bond issued by Toyota with a maturity date of 2020 and a stated coupon rate of 4.5%. In 2015, with 5 years left to maturity, investors owning the bonds are requiring a 2.1% rate of return. Step 1. Estimate the future cash flows related to this bond. They're receiving annual interest payments of 4.5%. The assumption is it's $1,000 face value. So they're going to receive $45 every year for 5 years. They're going to receive $1,000 at the end of 5 years. So what's their cash flow? To the bondholder, they're going to receive $45 every year at the end of each year for the next 5 years. To the bondholder, they're going to receive $1,000 at the end of 5 years. We want to know, what are those future cash flows worth to the bondholder today? How much are they willing to pay today to have the right to receive $45 at the end of each year for the next 5 years and $1,000 at the end of 5 years? What's the present value of those future cash flows? Well, we discount them at what the bondholder's required rate of return is. How much do I want to get out of this? 2.1%. Well, calculate the value by taking the present value of those interest payments which will be paid at the end of each year for 5 years, and determine their present value. Going back to present value calculation, that's an ordinary annuity calculation. And if you're using your financial calculator, now you can do this in one step, but let's do it in two. So the number of years for the interest payments are 5. The required rate of return is what you will use to calculate the present value, 2.1. I want to calculate present value, so I'm going to leave that at 0. My payment is 45 because that's the amount of the annuity, the equal payment every year over the next 5 years. I have to make sure my PMT on my calculator is at end, and I'm going to go up to my PV, present value, and calculate what is the present value of that $45, assuming a 2.1% return, and I'm getting $211.50. I'm going to do the same thing. There it is. Okay. I'm doing these separate. They did them all as one there. Now I'm going to say, well, what's the present value of that $1,000 I'm going to receive at the end of year 5? So my N is still 5. Whatever you use for your N and your I to calculate the present value of interest is also used to determine the present value of the principal of the bond. PV is 0 for now. My payments are 0 because this part of the calculation there's only one amount, and it's a future amount of $1,000. So I'm going to put $1,000 in future value and then arrow back up to PV and solve. And I get $901. So if I take the 901, I think it was, plus my interest, I think it was 225, something like that. I was close. 221. I get the bond's value is $1,112.80. Now in this slide, they're saying you don't have to calculate the present value of the interest and then the present value of the bond. You could do it all in one on your financial calculator. And how you do that is leave your N as 5 for your number of payments. Your I is 2.1. Payments are once a year, so the annual interest rate is used. PV will be 0 for now. Payment 45. Future value 1,000. I go back up and I solve for present value, and it gives me, so in the financial calculator, it takes all the information and gives you one value. Here's how much that bond is worth, $1,112.80. So if you wanted 2.1% rate of return overall on this investment, that's how much you should pay for that bond today. And that's what we're calculating here. Now a bond yield. Yield to maturity refers to the rate of return the investor will earn if the bond is held to maturity. And that is what we call the expected rate of return. So the yield to maturity discount rate that equates the present value of the future cash flows with the current market price of the bond. So normally, okay, when we're doing this in accounting, we say if you have this kind of market rate of interest, how much will your bond sell for? What this is saying is you could figure out that market rate of interest by comparing the market rate to the present value. To find YTM, we need to know current price of the bond, how much time there is to maturity, what's the par value, and what's the annual interest rate. So, what is the yield to maturity on a 6% bond that is currently trading for $1,100? So you know it's present value. So we're just mixing up some of the components here. So our time is, we know there's 10 years left to maturity. Okay. We're trying to figure out the interest rate. We know the present value is $1,100. Now, one of these numbers I think you have to put in as a negative using on your number pad, next the row 0, and then you have your period, and then you have like a minus sign in parentheses. You want to use that minus sign. So I'm going to go minus 60 for my interest, and then $1,000 in future value. So future value represents the bond face value that will be paid back at the end of 10 years. 60 represents the amount of interest that will be paid at the end of each year for the next 10 years. And my present value is $1,100 because that's how much it's selling for in the market. If I alpha solve, oh, I got an error. I did something wrong. Okay, let me try it again. Maybe I had to put two numbers in as negative. So I'm going to put my PMT and my future value in as those negative numbers using that minus sign in parentheses. I'm going to go back up and solve for interest. There we go. I'm getting 5 point, and that's a little bit more. Oh, sorry. Sorry about that, guys. I put 1,100 in my future value instead of 1,000. Let me solve again. And there you go, 4.72%. So there is the calculation within Excel if you prefer using Excel. So you're looking for the rate, the number of periods left are 10. The PMT is your interest payment over those next 10 years, $60 every year. PV is how much it's selling for today, and future value is the amount that you will actually receive in the future for the bond maturity. And it looks like you only had to put one thing in there as negative to do the calculation. They chose to use the PV as the negative. So if you get an error using a financial calculator, know that one of these numbers should be in there as negative. And the reasoning behind that, if you're wondering, and actually I saw this on Channel 44 one day when I was working out and they were going through a financial calculator. When they created the financial calculator, one of the values is looked at as money coming in. So maybe the present value is maybe money going out, and then the future value is the money coming back in. So one of them always has to represent a negative as if the money is going out. The current yield is the ratio of interest payment to the bond's current market price. So how we calculate that is we take the annual interest payment divided by your market price. So it's saying if you pay this much and get this much in interest, here's how much you're yielding each year. So the current yield on $1,000 par value with a 4% coupon rate. Remember, we only use that 4% to calculate the amount of interest. That's the interest rate on the bond times the 1,000. So if you're going to receive $40 of interest and the market price is $920, you're actually earning a 4.35% yield on your money. So you're making $40, giving up $920. Okay, so that's how we do the calculations. There's some important relationships though. The value of a bond is inversely related to the changes in the investor's present required rate of return. So their current interest rate. So as one goes up, the other goes down. As interest rates increase, the value of the bond decreases. Relationship 2. The market value of a bond will be less than the par value if the investor's required rate of return is above the coupon interest rate. So why is that? Well, the market value, the amount you'll pay for a bond, will be less than what you'll get in the end if your required rate of return is more than the coupon. So you have $1,000. You want a rate of return of 5%. The coupon rate is only 4%. The question here is, are you going to give all $1,000 to only get 4%? No. But you'd be willing to pay less than $1,000 to get 4%, because you'll have that extra money to invest somewhere else and get your other 1% return. And that's the thinking behind it. So bond will be valued above par value if your required rate of return is below the coupon interest rate. So now we're looking at the reverse. You want a 4% return. The bond is paying a 5% return. You are willing to pay more for that bond, okay, to get that 5% return. Discount bonds. The market value of a bond will be below the par when the investor's required rate of return is greater than the coupon interest rate. And these bonds are known as discount bonds. And that's what we call it. When the bond sells for less than its face value, it's discount. The market value will be above the par or face value when the investor's required rate of return is lower than the coupon interest rate. So they're willing to pay more. This is known as the premium bonds. So face value, in a perfect world, all bonds will sell at face value, right? But because investors require different rate of returns than maybe what the bond is selling, the bond may sell for more than face value or less than face value. If it sells for more, we call it a premium bond. If it sells for less, it's called a discount bond because it's selling for less. If the required rate of return is equal to the coupon rate, the bond sells at its face or par value. So it all depends on the interest rate on the bond and what the investor requires. And there's a great graphical depiction of what we just talked about. So as the rate of return changes, the value of the bond is also changing, given a constant coupon rate. So here's a 5-year bond at a 5% coupon rate. And you could run these calculations through your calculator. Okay, if the required rate of return is 2%, how much is someone willing to pay to receive a 5-year bond that pays 5%? $1,141. Someone wants a 5% rate of return, they're only going to pay $1,000. Someone wants an 8% return, well, this is only paying 5. I'm willing to pay $880. And this is all calculated through determining the present value of the interest payments the person will receive and that future repayment at the investor's required rate of return. Present valuing it, like we just did. The third, long-term bonds have greater interest rate risk than do short-term bonds, of course, because interest rates are always changing. So a change in interest rate will have a relatively greater impact on a long-term bond. Okay, so just 3 important relationships to keep in mind. And there we go. So the market value of a 5-year and a 10-year bond at different required rates of return. And you could see how they're, the interest rate, the blue is representing the 10-year and the orange being the 5-year, and how much interest rate changes affect the price. Because it's long term. It's a longer period of time. There's more risk involved. So our main risks then to anybody who buys a bond is interest rate risk, if it goes up or down. So if interest rates go up, market value of the bonds will fall, especially if they're above coupon. We talked about that, the relationship. Default risk. This may mean no or partial payment on debt. So the long-term bonds not only have an interest rate risk, but the risk of not being repaid. And then the call risk. If bonds are called before maturity date, bonds are generally called when interest rates decrease. So now the investor who is making a higher interest rate on that bond are forced to put their money into investments that are only paying a lower interest rate. But that's the risk. So here are your key terms, and I know there's probably some new terms here. Please just remember what a bond really is. We got to take ourselves back to that point. It's the corporation asking the public for money, and the corporation will sell the bond, but it's really them taking a loan. And we say sell because now that bondholder has the ability to sell that bond to somebody else. Ultimately, the corporation must pay whoever owns the bond interest at certain intervals during the life of the bond, the life of the loan, and then a face value at maturity. Okay, so I believe this is our end. Yes, here's some more. So if you have any kind of questions on this, please post them to the discussion board.